The 50 million options trading blow up, what really happened and how you can avoid it. Here's how one trading community lost over 50 million just from one setup in just a few hours, and how you can avoid making the same mistake in your own portfolio. Just before Christmas 2025, a popular option strategy that had worked for years suddenly stopped working, or supposedly suddenly. In a single trading session, over 50 million just disappeared. Some traders lost years of gains, others blew up their entire accounts, and some lost their entire life savings. This is the story of the trade that wiped out Christmas. A well-known trader who went by the name of Captain Condor, or was infamously called Captain Condor, David Chow, built a strong following using a strategy that promised passive income with just 5 minutes of trading a day. His following grew fast, his trades were profitable, he was even featured in the Wall Street Journal and other publications. But on December 24th, 2025, the strategy failed catastrophically. The trading group had collectively placed over 90,000 iron condor spreads, a call credit spread partnered with a put credit spread, which is technically 4 options legs. So that would have been 360,000 options contracts that were just sitting in the market overnight. And the reality is, the next day, the market moved, volatility collapsed, and the market just kept moving. And the losses hit almost instantaneously. When the dust settled, over 50 million was gone in just a few hours. Some traders in the group, as I said, lost hundreds of thousands, and even one member had to start a GoFundMe page just to cover some basic living expenses. In this video, I'm going to break down what went wrong. The overlooked risks that made the setup so fragile, really risks that shouldn't have been overlooked, and more importantly, what you can do to avoid these same pitfalls in your own trading journey. Because the risks that were taken are common risks people take without even realizing or analyzing it. And just to be clear, this is not to bash or to demean Captain Condor. It's about learning what happened, because this was a real world case study and a wake-up call for many traders who are following systems they do not fully understand, or they're increasing risks to chase faster results, and they're treating trading like a shortcut instead of a skill. The loss was in many ways a masterclass in what not to do, because this wasn't paper money or some prop firm reset or prop firm eval. This was real capital, real people, and real consequences. And what makes it even more painful is that much of it could have been prevented if those traders had been taught how to manage risk, scale properly, and trade with a real system instead of just following callouts blindly. So if you are a trader who values your capital and you want to scale without risking everything you've built, this video is for you. My name is TsE&x, and I am the CEO and founder of the Tradespeakeasy. We help experienced traders scale their portfolios into consistent 5- and 6-figure months using a dual profit system built around strategy, execution, risk control, and sustainable growth. Now let's talk about what actually happened December 24th. At the center of the collapse was a strategy built around the iron condor. The iron condor is a neutral strategy. So the expectation is that the market is going to stay within a defined range. Often you'll hear people talk about consolidation or digestion. So essentially it is a strategy that does not work when you have a trending bullish or bearish market. Because essentially what you're doing is you are selling a call credit spread above the market, and you are also selling a put credit spread below the market, and you are collecting premium from both sides, or collecting credit from both sides. And if the market stays between your two spreads, you win. It's a classic setup, and in theory, it's smart when it's done correctly. But here's where it gets dangerous. That this particular strategy and how they were utilizing it was very similar to a 0 DTE trade or a same-day expiration trade. Now, in fact, they were selling to open the strategy just before market close, but they were then having to potentially manage the trade in the next trading day because you can't manage options overnight. So the trade was essentially functioning very similar to a same-day expiration trade. Don't get me wrong, I love 0 DTE trading. It can be extremely profitable. In fact, many of our strategies are built on same-day expiration. But the key is really about how it is being structured, because 0 DTE contracts can decay very quickly, which means that you can make your money really fast. But if the trade goes wrong, you can start to lose very quickly with very little time to manage the trade. And the structure this group used, it wasn't just fragile, it was loaded with risk that most traders don't fully understand. And here's where it gets worse. Instead of managing losses with the structure or limits, this strategy used a method called the martingale strategy. It's an old school casino strategy, and it works like this. You bet $1. If you lose, you bet $2. If you lose, you bet $4, so on and so forth. So you just keep doubling up your risk with the idea that eventually you're going to win. And when you win, you're going to wipe out your previous losses and walk away with a small profit. And on paper, it looks clever depending on what the win rate is and if you can guarantee that particular win rate. But in reality, you run out of chip before the win ever comes. So with trading, your capital is limited and your margin is limited. If you can't keep doubling up, eventually you will blow up before you hit that big win. So in reality, instead of managing risk, the system was compounding it. It didn't just leave traders vulnerable, it made it inevitable that a big loss would wipe everything out if that loss came. And essentially December 24th, that's exactly what happened. But now let's break down some of the deeper issues on the strategy that they were utilizing, because this is what most traders overlook when they're learning about how to use options spreads. When you trade spreads, one of the things you will always hear me say is that I do not like trading tight spreads. You look on your option chain, you look at the strikes. Most often, do not like to trade spreads where the strike prices are back to back or are very close together. And the reason is because when you are trading spreads, you have 3 core Greeks that you are utilizing: price movement, also known as delta; time decay, also known as theta; and changes in volatility, also known as Vega. So the delta tells you how your trade reacts to the price movement. Theta tells you how much you're going to gain or lose from the time decay. And Vega is your exposure to volatility. The problem is when you have really tight spreads where they're back to back, which is what Captain Condor was utilizing, a 5-point spread on SPX. What ends up happening is that your Vega data and your delta data are so close together that as one increases, the other one decreases. And so there isn't any true decay in the value, because when you are a seller of options, your idea is that you're going to sell high and buy back lower. So you need decay. And the idea would be that when you sell spreads, you want the delta, the Vega, and the theta to be decaying very efficiently so that you can buy to close for your scalp or for your win or your return. But when the spread is so tight and the Vega and the delta are almost moving in combination with each other, you aren't actually effectively getting any decay in the structure, which means you are only basing the win of the trade on the time decay, which then requires you to stay in the trade for a very long time to get that time decay. Now, the reality is that the SPX is something that can move, and it can move fast, and it can really move much further than you are expecting. And the reality is that they were doing this strategy over the Christmas period. Christmas is well known for being a very low volume time and a very low volatility time. So what ends up happening is that even if the SPX isn't moving slowly, you often just get a trending grind up, which is what they experienced when they started doing this sell, double up, sell, and double up into December 24th, 2025. And the reality is that because they had such a tight spread, it gave them literally no margin for error. So the overall trade structure was objectively irresponsible, sorry to say. And the fact that the people followed it shows that they never really understood or learned how options spread work correctly. They were just interested in copying the trade because it had worked over a long enough period of time, and they hadn't faced that inevitable waterfall moment where they couldn't keep doubling up the trades because the win had never actually arrived. And yes, copying works until it doesn't. like they experienced. And that's the real flaw. People weren't learning a system and how it really works in the intricate features. They were trusting someone else's thesis and fascinated by the marketing of profitability, a profitable 5-minute strategy that you can do without understanding the mechanics underneath it. But learning options is learning a skill, and you have to be willing to learn. When you actually learn it the right way, the knowledge can help you generate $10, $20, $30, $40,000 a month. But only if you understand why the trades work. You have to be able to understand the risk and the why behind any trading strategy. Just copying trades leaves you vulnerable. You are always one bad assumption away from destruction. Now at the Tradespeakeasy, we believe in something very, very different. Our system is built to profit in multiple types of market conditions, whether it's trending, consolidation, or even choppy. We don't rely on one trade setup. We combine two types of trading systems. One is our systematic trades, which are just rule-based trades that have been back-tested and forward-tested. And the other set are discretionary trades, which use real-time market reads, setups, and live trade management data. This dual profit system gives you the structure when you need it and the flexibility when the market demands it, giving you multiple ways to be consistently profitable. And most importantly, it protects you from markets that wipe out $50 million on a Christmas Eve. We teach traders how to scale without increasing stress, how to compound without over trading, and how to recover without panicking. Because the truth is, trading doesn't need to feel like gambling. In fact, it shouldn't feel like gambling at all. With the right system, it becomes a repeatable skill. And here's how we help traders scale to 5- and 6-figure months without blowing up their gains after one good week. So if you're serious about turning your trading into a real high income skill, we're hosting a free masterclass where I walk you through exactly how this system works and how to apply it to your own trades. Click the link in the description to save your seat. And don't forget to like and subscribe for more real world trading breakdowns, educational content, and strategy. I'll see you in the next video.